Michael Burry is head over heels for Stellantis stock, making it his top investment. Stellantis is this huge car company owning brands like Peugeot, Jeep, Chrysler, Citroën and more. They're the second biggest in Europe, just behind Volkswagen with 18% market share. Right now their stock is standing around its highest point of around 21 bucks, making the whole company worth 66 billion euros. This year already, Stellantis gained nearly around 47% year to date. They are loaded with cash, with around 52 billion euros, and they only owe around 29 billion euros. Crunching the numbers, and their enterprise value comes around 43 billion euros. Stellantis is making around 190 billion euro in revenue, with around 20 billion euro in profit after paying all expenses, and around 14.5 billion euro in free cash flow, which is the money that would end up in your pocket if you own the entire company, and the cash that is not needed for investing or operating activities. Last quarter, they managed to grow revenue by 11% year over year and earnings by a massive 30%. And they're also paying around 7% dividend, which is pretty sweet. With these numbers, Stellantis is actually one of the cheapest stocks in the stock market. They are trading at 0.22 times their revenue, 2 times their earnings, and 3 times their free cash flow. So technically, if you buy the company as a whole and collect 2 years of profit or 3 years of free cash flow, you will break even. So far, everything looks quite bullish on Stellantis' case, and the stock is actually looking quite cheap. Now, here's the twist. They're falling behind and lagging on the EV race, on the electric car race, and their market share is actually dropping a little bit, especially in Europe from 20% last year to 18% this year. They plan to invest around 50 billion euro, almost as much as their market cap, to catch up in electrification. This will definitely impact their financials until this investment starts paying off. However, the good thing is that they have this cash lying around in their balance sheet, so they can pay everything in cash, no problem, without any need for financing. But taking into account the current war in the EV market, with China investing heavily in electric cars, and I actually see more and more Chinese electric vehicles on the road these days, which may have been the reason for Tesla to start cutting prices, we can all agree that Stellantis will not have an easy job competing with these guys. And these are additional to the current challenges in the EV market, such as worried customers around charging, or the sales of electric vehicles that have been dropping in the last couple of months, or the horrendous second-hand market for the used electric vehicles. We heard about the ban on internal combustion engines that coming in Europe and UK by around 2030 or 2035. They recently amended it to allow for an exception for economic cars, which Stellantis has quite a lot of. So this will be beneficial for the company in the long run. In their attempt in the EV market, they partnered up with CATL to obtain batteries. And they also invested in Leapmotor, a Chinese EV manufacturer. Now they plan to have over 40 electric models on the market by end of 2024. The company predicted in their recent report that they can bring over 20 billion euros in free cash flow by 2030. This is an increase of 5.2% every year for the next 7 years, which is, in my opinion, not a very out of reach goal. If they pull it off with 4 times multiple around today's valuation, they can be sitting on an 80 billion euro market cap by 2030, or around 9 to 10% annual growth. But to be honest, although low multiples are quite common in car manufacturing industry, Stellantis is not trading that expensive. It might actually be trading for the worst case scenario here. So keep an eye on Stellantis and don't rule it out easily.